All right, let's run through our agenda, which is basically your study syllabus for today. First, the 3 types of inventory. Second, mastering the FIFO method. Third, weighted average cost explained. Fourth, misstatements and net income. And finally, your ultimate exam cheat sheet. Let's get into it.
Section 1. The 3 types of inventory. Visualizing the factory floor. Let's start with physical reality before we start attaching dollar signs to everything. So by definition, inventory isn't just the final, polished product sitting on a retail shelf. According to accounting standards, it's kind of the whole shebang. It's anything held for sale, anything currently in the process of being made, or even the raw materials consumed to actually make those goods. It encompasses the entire life cycle of a product within a company.
To really picture this, think about a manufacturing plant. Inventory travels chronologically. Step 1, you have raw materials, your basic building blocks. Step 2, that turns into partially completed work in progress on the factory floor. And finally, step 3, the finished goods that are actually ready for the customer. Now, a retail store might skip straight to finished goods, but manufacturers, they've got to track all 3 of these stages.
Which brings us to the biggest question you're going to face on your exam. How do we assign a monetary value to the units just sitting there on the shelf at the end of the year? You know, it's not just a simple counting exercise, it's valuation. And the method a company picks can literally alter their reported financial health.
Section 2. Mastering the FIFO method, chronological costing. Let's dig into our first major valuation method.
Okay, let's talk about FIFO, which stands for first in, first out. The core assumption here is super logical. It assumes the very first items you buy, the absolute oldest ones, are the first ones you issue to the factory or sell to a customer. And because of that, the newest, most recently purchased items are what's left sitting in your closing inventory. It perfectly mirrors how a business naturally wants to clear out old stock before it deteriorates, right?
Let's ground this with a real-world example from our sources. Imagine a manufacturer buying condensers for radio sets. Over the month of December, they buy batches at wildly different prices. They get 900 units early on at $50 each. Later, 400 units at $55, a tiny batch mid-month at $60. And finally, right at the end on December 28th, they grab 800 units for $47. Under FIFO, we have to track these chronological receipts meticulously.
So let's say they used 1,600 units that month, leaving exactly 1,000 units on the shelf. Since we're using FIFO, those remaining 1,000 units have to be the newest ones. So we grab the 800 units from that final December 28th purchase at $47, and we take the remaining 200 units from the batch bought right before that at $60. Run the math, and our closing inventory value is exactly $49,600.
Moving on to Section 3, Weighted Average Cost Explained, blending the prices. Here is the second heavyweight method you need for the exam.
Now, let's contrast FIFO directly with the weighted average method. Instead of pretending there's this perfect chronological physical flow where you pick specific batches from specific dates, weighted average just smooths everything out. It blends the total cost of all the available units together into one uniform average rate.
Let's run that exact same radio condenser data through this method. If we add up the total cost of all 2,600 units purchased throughout December, it hits $133,100. You just divide that total cost by the 2,600 total units, and boom, you get a new perfectly blended average price of $51.19 per unit.
So, what happens when we multiply that new average rate of 51.19 by our remaining 1,000 units? We get a closing inventory value of $51,190. Think about that for a second. Just by switching our accounting assumption from FIFO to weighted average, our inventory value jumped from $49,600 to over $51,000. It totally changes the financials. And let me tell you, examiners absolutely love testing this exact concept.
Section 4. Misstatements and net income. The exam trap.
This brings us to the ripple effect. What actually happens to a company's profit when these inventory counts or valuations are messed up? You have got to memorize this formula. Cost of goods sold equals opening inventory plus purchases plus direct expenses minus closing inventory. I want you to pay special attention to that last part. Closing inventory is subtracted.
And here is where the trap snaps shut. Because closing inventory is subtracted, if you artificially overvalue your closing stock, you shrink your cost of goods sold. And lower costs mean an artificially inflated, overstated net income. The company suddenly looks way more profitable than it really is. On the flip side, overstating your opening inventory does the exact opposite. It understates net income. Understanding the seesaw relationship is literally exam gold.
All right, Section 5, your ultimate exam cheat sheet, bringing it all together.
Before we summarize the methods, you have to remember the golden rule of conservative accounting. Regardless of the method you pick, you always have to recognize anticipated losses immediately. This means inventory must generally be valued at the lower of its historical cost or its net realizable value, which is basically just what you can actually sell it for minus the cost to sell it. If the market value tanks below what you paid, you write it down immediately. Simple as that.
Okay, let's lock these methods in. We've talked about FIFO and weighted average. There's also specific identification which matches exact costs to rare, non-interchangeable items like expensive medical equipment. Those are all totally fine by accounting standards. But then there's LIFO, last in, first out. The source explicitly points out that LIFO is considered an irrational assumption. Why? Because it assumes you sell your newest items first and deliberately leave the oldest, decaying items sitting on the shelf. That makes zero sense, which is why LIFO is generally not permitted by modern accounting standards. Remember, knowing what isn't allowed is just as important as knowing what is.
So as you head into your exam, and eventually into your career, ask yourself this. Does the valuation method chosen reveal a company's true operational profit, or is it secretly masking a critical misstatement? Because at the end of the day, inventory isn't just counting boxes in a warehouse. It is the absolute foundation of a company's reported financial reality. Good luck studying, keep reviewing these concepts, and go ace that exam.